Hi, this is Jim Cunningham. I have with me Christina Lindsay, and we are talking about the One Big Beautiful Act of 2025. This is the big act that was passed earlier in 2025, and we're going to unpack this for you and hit the highlights. So there's been a lot covered by a lot of smart people, getting really technical, but we're going to give you kind of the 60,000 foot view and really how this applies to you as maybe an individual or maybe a business owner. Like, what are the things you should be paying attention to in 2025 to make sure that your income tax bill is lower? And then certainly if you're concerned about passing wealth from one generation to the next peacefully, I might add, how does that affect that wealth transfer? So if you're watching this on YouTube, please subscribe to our YouTube channel and hit the little thumb and bell, and you will be alerted to when our content drops, which is typically at 6 p.m. on Thursdays, California time. So the Big Beautiful Act explained. It's now law, Christina.
It
And
is now
Christina
law.
Lindsay is joining us from Ascent Wealth Management, and I'm happy to have you here. It rewrites major portions of the tax code. It extended prior changes that were passed during the first Trump administration.
Mhm.
And what this did is essentially extended that Tax Cuts and Jobs Act of 2017, making many of these provisions permanent. This did increase the SALT deduction, which is not what you put on food or what you use to preserve ham or fish, your bacalao, whatever it is. SALT is state and local tax. So that is an acronym, state and local tax. State tax in California, right, Christina? We have what? California income tax. It's pretty high. Local tax might be the property taxes that you pay. Okay, so state and local taxes. New perks for seniors. Christina's going to cover that. Qualified opportunity zone investments. That's been extended. 529 rules and more. So we will get into that. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've been an attorney for more than 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, as well as a real estate broker, securities insurance licensed, and a pilot single engine land instrument rated, although I'm not current. These are the attorneys in our firm. We are dedicated to all things peaceful transfer of wealth from one generation to the next while minimizing taxes, as well as reducing taxes during your lifetime, reducing income taxes. This is Christina Lindsay. She's joining me from Ascent Wealth Management. She's a certified financial planner, which I would highly recommend that if you are using a financial advisor, really consider a certified financial planner. And we'll talk about a little bit about that, why that's a good idea, especially for these types of things, because it's not just about your investments. It's not what you make, it's what you keep. And taxes play a big role in that. So I'm a lawyer. I have my disclaimer here. Christina will have her disclaimer. This is really important. So I'm a lawyer and I'm going to talk about legal concepts. Please get legal advice. Whether it's from our firm, and we have plenty of lawyers here, or whether it's another firm, please get competent advice from a savvy lawyer. You don't want to do this on your own. This is not a DIY project. Really, you need many minds coming together, MINDS, many minds coming together, working on this. And Christina, I will let you give your disclosure.
Yeah, just as you have your legal disclosures, so do we, as we are registered both RIA with the SEC, and we also have a registration with FINRA with our broker-dealer. So none of this is deemed investment advice, as everything that we do for securities or the purchase or sale of securities is with having better context and knowledge, was as a fiduciary, being able to act in the best interest of our client and have full context. So none of this should be deemed as a recommendation or advisement to, do a specific product or strategy based on this general information here.
Now that we have that out of the way, let's talk about what did not change, Christina.
Yeah, so I think that, by and large, I kind of want to start at that 60,000 foot view of, people kind of go, gosh, this really didn't change a whole lot. What it really did was prevent a reversion back to prior to 2018 and prior to the Tax Cuts and Jobs Act. So all of the tax rates in which we've all become accustomed to over the last really the last 8 years, 7, 8 years, we are now keeping those tax rates permanent. It has increased the estate tax exemption. So while some people might not feel a lot of change, it prevented what could have been some significant tax change, some significant estate tax law change, because it would have reverted back if the Tax Cuts and Jobs Act sunsetted. It was set to sunset at the end of 2025 and create new tax rates, new estate tax rates as of January 1st of next year. So all of that has really been prevented and avoided with this tax bill. So the current estate tax exemption is 13.99 million per person for 2025, increasing to 15 million and then indexed for inflation starting in 2026. So the nice thing about this is it does create some permanency to the tax rates, the estate tax exemptions. Now, could that be changed in future legislation or administrations? And sure, could it? But at least we don't have this ticking reversion like we did with the sunset of the current the tax code that existed prior to the One Big Beautiful Bill. We now have some sort of consistency to predict going forward. It also did make the QBI deduction, the Section 199A. Now, again, that is excluded for people like Jim and myself, anyone that is in the trades or services business, doctors, CPAs, financial advisors. Those that are in the services business do not benefit from the Section 199A. But if you have passive real estate income, other business income, that is a big win in the tax code.
Yeah, and I would say qualified business income. Here's what this means is you're able to deduct 20% of your income. So it kind of gives you a 20% break on your taxes. This is a very powerful tool. And I'm assuming that if you're a business owner, right, or you're self-employed. Now, if you're W-2, you don't get this. Christine and I don't get this in our professions. The W-2 people really, and I think on this bill, the W-2 people end up with the short end of the stick. So if you're a highly compensated W-2 person, you don't benefit like as you would if you owned a business and were and working in the business. So it's very important to understand that I think this tax bill makes permanent the favoring of people who are running or owning a business and working in the business versus somebody who is who's W-2, right? If you kind of look at those two. So it's something really to pay attention to because many business owners have W-2 income and they have business income. So this is why it's important to meet with your tax advisor and your financial advisor to make sure that it's the right balance, that you strike that appropriate balance.
Or people that have passive real estate income can benefit from
True.
QBI as well. So to the extent that their properties aren't fully depreciated, if their properties are fully depreciated, that's a whole nother ball of wax where we need to get into some more detailed planning discussions because you can't take that deduction if your property has been fully depreciated. However, if you do have passive real estate income, and that can also benefit from QBI. But I think that this is really kind of the nuts and bolts of the tax rates is, it's in particular, most of middle America in the $200,000 to $400,000 annual joint income range. And, the middle class, if you will, was set to have anywhere from a 16 to 18% increase in their tax rates had this bill not been passed. Had the Tax Cuts and Jobs Act sunset and reverted back to the prior to 2018 tax rates, it would have meant a 16 to 18% increase in your tax rate. So those that were in the 35% tax bracket would have jumped to the 39.6, and those that were in the 24% bracket would have jumped to the 28% bracket. So these are some significant tax increases that didn't go into effect. And that, coming off of, years of COVID inflation and, certainly where we're not going to get that cost of goods back, this would have been a pretty significant hit to most Americans.
Yeah, I mean, this is really good for the people who are I would characterize as working hard, right? These are people who are getting up, going to work every day, eking out a living. And then to have that extra tax on top of that means there's less money in your pocket, which means there's less economic activity. So there's a question that we had before we started was this a good bill or not? I think if you're in that $200,000 to $400,000 to $600,000 range, it's a good bill. It's a net positive. So it's a good thing.
So what could have been, especially with the estate tax exemption, I think this is one of the things that, we had such uncertainty as to what was this going to be. It was really difficult for people to plan beyond December 31st. And if people didn't plan or were waiting till the 11th hour, we could have had an estate tax exemption that could have been reduced to 6 million per individual. So, including real estate, values of businesses, it could have pushed quite a few people that, if you're single, you own one home and have a business, you could very quickly exceed in California that $6 million threshold for certain individuals. So this increases that estate tax exemption to 13.99 million for this year, going up to, again, that 15 million indexed for inflation starting in January of next year.
So what did change?
Yeah. So what did change? I think that there is quite a bit that changed with respect to SALT, standard deduction, Social Security deduction. We're going to kind of get into some of that. The itemizations in the 37% tax bracket, car loan and mortgage interest. So these are all some of the things that are changing on the deduction side of things. And then you also have other provisions such as above the line charitable contributions. So for those that are familiar with qualified charitable distributions, where you can take an RMD, or once you've attained age 70 and a half, you can take charitable gifts from your IRA, not recognize it as income, and direct it directly to the charity. Or if you have a required distribution when you attain age 73, or in the future for those born after 1960, it's age 75 when the government says you are required to take a certain amount from your retirement accounts and 401ks, you can send that directly to charity, not having to pay any income tax on it. And it's what we call an above the line charitable contribution. That will start next year. So we get a lot of questions right now. I'm not talking about IRAs, but the new non-retirement above the line charitable contribution, where you can now take, let's just say that you only take the standard deduction, you don't itemize on your tax return. Each individual, if you're married, it's $2,000. If it's individual, it's $1,000, can be donated directly to charity, not having to then itemize. And you can do that reducing your income. That goes into effect January of 2026. So it's those that have discussed it and say, hey, can we take advantage of that? It doesn't go into effect this year. It's next year. One of the things that we were waiting to see is the solar tax credits. We'll kind of get into that, but by and large, the residential tax credit for solar is going away at the end of this year. So if you do have a need to do solar on your primary residence, or even second homes or vacation homes, on single family residences, the solar tax credit will expire at the end of this year. Qualified opportunity zones, those have been extended, which is great to see. And then there's some new things with 529s and Trump accounts. So we'll kind of get into that a bit more detailed here. Starting with the standard deduction, this is something that certainly will be phased out for some individuals at certain income thresholds. But the standard deduction, so if you don't itemize on your tax return, or even if you have certain expenses that just don't exceed the standard deduction, for a single individual, the standard deduction is now made permanent at the $15,750. There is an additional deduction for age 65 and over, or if you are blind. And then there is a new temporary deduction. This is phased out after 2028. But this additional deduction for those that are 65 and older, individuals, 6,000, married filing jointly, 12,000. So this could theoretically take your deductions, if you're married, up to your standard deduction up to 46,700. Again, this phases out after 2028, and it is phased out for single. It's phased out at $175,000 of income. For married filing jointly, it's phased out at $250,000 of income. So if you have over those thresholds, these will not be able to be taken advantage of to their fullest extent. But this is where there's been the greatest confusion with respect to Social Security. There has been a lot of false, misleading headlines that are stating that Social Security will no longer be subject to taxation, which is not true. It's just that many people will benefit from these increased deductions over the age of 65 that will make less of their Social Security taxable.
You know, I'm glad that we have this slide on here because for people who make charitable contributions, whether it's to, you know, your church or your synagogue or whatever, or maybe just a charity, we've covered this in other webinars. Sometimes it makes sense to stack your contributions in 1 year, right? Now you can do that with a donor advised fund. You could do it directly to the institution. But if someone's going to give $1,000 a month, let's say, it might make sense to stack up 3 years worth of gifting at one slug of time, because you do need to look at these standard deductions, right? Because if you make a charitable contribution and you don't surpass the standard deduction, you're not getting a tax benefit. So I think we've covered that in other webinars, but it's really important to pay attention to this. And I think it's even more important with this expanded standard deduction.
Absolutely. So I think that this kind of hopefully will clear up the question of, is Social Security still taxable? Yes. So there's just this increased additional standard deduction of $6,000 per individual. So again, an additional $12,000 of deduction if you're over 65. As a result, 88% of retirees are expected to pay no tax on their Social Security benefits, but high income earners, whether it be income earning in your working still or in retirement with passive income, if you have over these income thresholds, you're still going to pay more tax because you're not going to get the benefit of the full deduction. And keep in mind, this does phase out. This is an additional deduction above and beyond the normal 65 and over standard deduction. This will phase out after 2028. So just know that this is temporary unless legislation is enacted after 2028 to make that permanent. This is a temporary benefit for those that are 65 and older, which just reduces the amount of Social Security that will likely become taxable. So is it still taxable? Yes. If you're over these thresholds, is anything really changing on your taxation? No.
But it is for 88% of the people, right?
Yes.
But and also an RMD, a required minimum distribution from a retirement account, counts as income, right?
Yes.
And so this is why looking at a Roth conversion might be appropriate. And this is why working with a financial advisor and you can't wing this stuff. By the way, there's too much math. It's kind of like putting a person on the moon. Like there's like orbits and math and, you know, the speed of light and all this weird stuff that you have to figure sending someone to the moon. There's a similar mathematical analysis on a Roth conversion. It may not seem like it, but it's a fairly complex set of maths you have to go through to get to the appropriate Roth conversion. And one of them, you know, is this going to be permanent, Christina? If you had to go into a crystal ball, who knows?
Who knows? It depends on, you know, there's that short-term increase in our deficit, but that is supposed to come back down in 2028 due to the reduction in tax rates and tariffs and all those things. So our deficit hit, if you will, is supposed to start becoming less and actually starting to see a reduction in 2028. So kind of the timing of when the budget deficit is starting to come back down a bit in 2028 based on projections of the CBO. It'll be interesting to see where things are at, if this is something that they could enact permanently or if it will just be on the chopping block.
But to be clear, it is going away in a few years.
As it stands right now, this is temporary.
Unless it's made permanent, correct.
So itemized deduction limits for the 37% tax bracket. This is what's new. So this is fairly nuanced. But those that are doing a lot of itemized deductions, a lot of charitable giving, and taking advantage of that to the amount that their taxable income plus itemized deductions exceeds the 37% tax bracket, what it's going to do is result in only being able to limit 35% deductions. So it's a fairly nuanced calculation, but the nuts and bolts of it is if you're giving getting a ton of itemized deductions and you're in that 37% tax bracket, federally, it will kind of reduce your net effect to 35% of every dollar that you itemize deductions.
I love it. 2/37.
Right.
Like,
It's
it's like fun
like I
with
said, it's a
prime
very
numbers.
nuanced
Right.
calculation.
Fun with prime numbers. Like, let's just make it more complicated, people. Like,
Yeah.
seriously, this is
Yeah.
crazy.
Yeah. This is a big one. This is one of the things that I think that did change. So for those that are in the tips and overtime business, those that are waitresses, hairdressers, those that work on a lot of tips and overtime, this is a new one. Certainly, if it's qualified tips, then it's going to be considered a below the line deduction as well as overtime. It's going to become available. So even if you don't itemize, you take advantage of the standard deduction on your tax return, you're going to get benefit for not being taxed on 25,000 of tips essentially for tips, and then 12,500 of overtime. So 25,000 if you're married filing jointly. So it is reduced if you're over certain limits. So if you're single filer, that limit is going to be roughly 150,000. So if you make over 150,000 with tips, you're not going to start to benefit from these deductions. Married filing jointly, that limit is $300,000. But for a couple that is if you have two partners that are working and you've got 300,000 of household income and one of those is a waitress or waiter and gets serving tips or bartender, those tips, if you're under 300,000 of household income, will be not subject to taxation. So this again also phased out after 2028, but this is something that is new in the tax code.
I'm kind of chuckling as you're talking because when this bill passed, there were a flurry of emails I got from lawyers. Basically, they're like, hey, can we, shoehorn our way into getting tips? So if you're going to pay an attorney $100, can you pay the attorney 80 and tip the lawyer 20? And no, it doesn't work that way. This is traditional.
No, this is
tipped.
limited.
Yeah, no, but this is like traditionally tipped industries. So in my view, in my humble view, not that it matters, I question whether how much this is going to benefit people at all, because
I think a lot of people that work as bartenders or waitresses and waiters, especially those that there's some people that work and make a ton of money. There's
I
people that
know,
work
but are they
at
getting that in cash anyway?
tips.
I don't know. Be that as it
I don't
may.
know how many people actually go to cash and pay tips for dinner anymore. They put it all on the credit card.
Yeah, that's true.
I don't know how many people are operating cash, but it is going to be reserved to traditional tipping jobs,
Yeah.
servers, bartenders. This is not something that is going to become available for our industries to start receiving compensation and tips just to skirt the issue. So
Yeah, so if you're like a coder or programmer and you go to your employer and say, hey, can I get tips instead of comp? It's not going to work.
not going to work.
All right. I think this, for those of you watching this, this is probably the most important slide, I think, for this big reason that's in highlighted in yellow. It's the lawyer's highlighter I got out, and I put this on the slide. The effective federal marginal tax rate is up to 45.5% on income between $500,000 and $600,000. What is going on? The way the bill is written, your state and local tax deduction of $40,000, which is worth about $10,000 roughly, right? You're paying $10,000 less in federal tax. That goes down between income of $500,000 and $600,000 if you're married filing jointly. That goes down from 40 to 10. So you lose a $30,000 deduction, which means your taxes go up $10,000, which means that your effective rate, your effective federal rate, essentially goes up. Now, if you don't quite get that explanation, I'm going to explain it a different way. If you make $500,000, you get a $40,000 state and local tax deduction. That includes your property taxes, your state income tax, right? If you have income of $600,000, you only get a $10,000 deduction. So you lose a $30,000 deduction. This is a really big deal.
Yep.
I think this year, next year, the following year, it is extremely important to meet with your CPA, your financial advisor, and your lawyer, quite frankly, because this does many times involve legal maneuverings. Don't just willy-nilly sell that stock, or don't willy-nilly do that Roth conversion. You really need to pay attention to this. This is especially if you're between 500,000 and 600,000. If you have any ability whatsoever to control your income, if you're a business owner, California has a workaround for the state and local tax. It's called the pass-through entity tax. You don't have the same benefit in New York and New Jersey. So that is one benefit of living in California, is you pay tax at a flat 9.3%.
That's if you're a business owner.
Business owner, right. So, but if you're W-2 and you're making 500 versus W-2 making 600, you're going to be paying a lot more in tax as a percentage of that slug of $100,000 income. So that's very, very important to pay attention to. Any comments on that, Christina?
No, I think that this is another thing that is also phased out in 2030. So, while this One Big Beautiful Bill Act, OBBBA, did end up extending tax rates and estate tax limits permanently, there are several things that are phased out, this being one of them. And it not just phased out with income limitations, but you also have a phase out in 2030. So I think that there's a lot of income ranges that will benefit from this, but do keep in mind, as Jim had mentioned, you've got IRA income, dividend income, passive income, not just earned income that counts towards your total household income, portfolio income. So if you exceed these limits, you are going to be phased out from 40,000 back down to that 10,000. But by and large, those that were severely hindered by the SALT cap over the last several years since the 2018 Tax Cuts and Jobs Act, this does really move the needle for several people to take that deduction.
Right.
Car loan and mortgage interest. So this is an interesting one. So if you bought a new car, there are so many requirements that go with it, but your dealership should be able to tell you if you financed a car and it's a US made car, must be assembled in the US. There's only new vehicles. It can't be a used vehicle. It has to be for personal use, can't be for business use, can't be Section 179 for your business. But if you do a personal purchase of a US made vehicle, you can deduct up to $10,000 of that interest per year. Again, subject to income phase outs. But if you do purchase a new car or did purchase a new car in the calendar year 2025, you can start taking advantage of deducting the interest that is financed for a car. So that's new. But it has to be a domestic US assembled car. So you can't just go do a Porsche and it's not a domestic,
But a Mercedes might be assembled in the US.
Might. So there's certain cars that qualify for this.
I don't know. Are they still assembling Hyundais, or did they deport all the people?
I don't know. But that's new. Auto loans have not historically been deductible in the for individuals, non-business owners. It has not historically been deductible in the U.S. tax code. So that's new. Mortgage interest, and that is remaining, essentially making interest on mortgages deductible up to $750,000 of loans. And so you've got mortgage interest deductible, again, capped. So you can't have $1 million mortgage necessarily and deduct all the interest, but $750,000 for joint filers, $375,000 for single filers is deductible. And certain mortgage and insurance premiums, if you have mortgage insurance, may also qualify.
I was actually surprised that this didn't get raised.
I am too. That's one that I'm too.
I will say it's a little disappointing too, because I know a lot of young people, when you look at how much housing costs in the United States, and especially in California where we are, it's unfortunate that there is not a bigger deduction to get more money into younger people's pockets so they can go out and spend it and provide for their family. So a little bit disappointing, but it is what it is. What
Absolutely. Absolutely.
All right. So estate and gift tax, in 2026, for people who die in 2026, $15 million passes free of estate tax. Now I'm talking about U.S. citizens. I'm talking about green card holders and U.S. taxpayers. Okay. So that's what I'm talking about. This is not people who are non-resident alien. They have a $60,000 exemption. So this is very important to understand. So if you're watching this and you're outside of the United States and you own property in the US, you really do need to, and something we help international clients with, is structuring your estate plan to bypass this rather low exemption. For 2025, it remains at $13.99 million. Now, the annual gift tax exclusion, this is the amount of money one person can give to another person and not file a gift tax return, is $19,000. So, Christina, I could give you $19,000. I could give your husband $19,000, and I don't have to file a gift tax return. I have 3 children. I could give each of my children $19,000. If you're watching, it's not going to happen. My wife can give each of my children $19,000. So that's basically, what is it? Almost $120,000, $114,000, how the math works out. Mm-hmm. We can do that and not have to file a gift tax return. I think it's probably going to go to $20,000 next year. This is indexed to inflation, and that would be a 2.6% increase. And I think inflation's right around there to get us over to that higher amount, but it may not hit that. We cover this in other webinars. SLATs, Spousal Lifetime Access Trust, GRATs, Grantor Retained Annuity Trust, and Family LLCs remain powerful tools. They remain popular tools. Also, dynasty trusts you could put in there. These did not go away with the Big Beautiful Bill, the One Big Beautiful Bill Act. So those are still in play. Grantor trusts, we cover that in other webinars. Basically, you can give assets away. You could put $13.99 million into a trust this year and sell the assets in there. And if you gave those assets away, you can end up paying the tax bill on that, which is a backdoor way of giving your family more money. That is still around. Portability. We cover this in other webinars. If you're married or know somebody who is married, this is very, very important. When one spouse passes away, now this is spouses only, not registered domestic partners. In California, those terms are interchangeable, but this is a very important distinction between registered domestic partner and spouse. One spouse dies, the surviving spouse can inherit the deceased spouse's ability to leave $13.99 million free of federal estate tax. This is a very powerful tool. You have to file a Form 706, which is your federal estate tax return, in order to pick that up. And that's something we do regularly in our firm. So if you know someone who's lost a spouse, or if you've lost a spouse, this is really something you're going to want to pay very close attention to and decide, should you take action or not, right? Now, the other component to this is we have seen some pretty wild political swings in the last few years. The smart kids say that the swings aren't going to get any less wild in the near term. We have one party in power. We could just as easily have another party in power that maybe increases taxes. So in 1973, the federal estate tax was 77%. Right now it's 40%. So you could have another party come into power that increases taxes. So what they could do is, instead of it being a 40% death tax, that could easily go to 77. Congress passes a bill, president signs it. Also, they could lower the amount that you could leave tax-free. The nice thing about portability, the reason why I'm saying this, the nice thing about portability is once you pick up that portability, you have that as a surviving spouse. You have that for the rest of your life, provided you do not remarry. If you remarry, then you forego that benefit. So don't get comfortable. Political winds can change. Pay attention to this. If you're a high income earner or have high assets, you really do need to pay attention. And this is a great webinar to watch because you're paying attention. This is pretty cool.
And one of the kind of just going back to is we will probably do another webinar that is more granular for those that are going to be phased out and hit that SALT cap.
Yeah.
There is a way to do non-grantor trusts and multiple trusts that take advantage of each getting their own SALT deduction up to $40,000. So if you're hitting that SALT cap and you've got significant income, there are ways to get around that, but you have to create additional non-grantor trusts. So that's a whole nother ball of wax. It's a whole nother deeper layered conversation. So for those that are, want to talk about that in greater detail, Jim and I, our teams can certainly have a conversation one-off, but we'll probably have to cover that another day.
Yeah, an easy example, and I'm glad you raised this point. An easy example is if you're selling a stock portfolio and maybe you're liquidating a rather large position and you're limited on the amount of state and local income tax deduction you can take. You can basically stack those $40,000 deductions in various trusts, and that's what Christine is talking about. You have to do the analysis. Is the juice worth the
Worth the
squeeze?
squeeze.
Is the juice worth the squeeze? Is the hassle factor worth it? Or are you just like, you know what? It's not worth it. So believe
Yeah.
me, that is something Christine and I talk about with our clients pretty much every day. Is it worth it? So, and for some people, they go, I'll do anything. I will crawl over molten glass before I pay another dollar in taxes. Other people are more sanguine about it. So it's really a personal decision. Okay. Capital gains tax. I do want to mention this because this is another thing that remains unchanged. Capital gains tax rates remain unchanged for now. Now, California, it's regular income tax. We don't have any special capital gains tax rates, but federal has remain unchanged. And really, this is something I think not enough people pay attention to, Christina, because if you're in that gap of where you've stopped working, but you don't have RMDs, maybe you're living off savings and you don't have any income, if you're married filing jointly, you can exclude almost $100,000 in gain and not pay any tax as a taxpayer. So this is why it's important to work with a financial advisor, CPA, lawyer. If you're going to liquidate a position, like you maybe have a concentrated position of securities, you might be able to do that on largely a tax-free basis or mitigate those taxes. Again, lots of different strategies, but really pay attention to that. Capital gains tax rates have not changed. Step up in basis preserved under the big, beautiful bill. Very, very important. Canada does not get this. I mean, they don't get this benefit. What that means is if I own $10 million in NVIDIA stock, let's say I just so wish I could do this, Christina, all these stocks that went up. If you could just tell yourself, just put 10,000 into this stock. And I think everyone watching this is like, yeah, man, me too. So if I bought NVIDIA a long time ago and it's gone up to, $1 million, if I sell that today, I might pay about $371,000 in capital gains tax, state, federal, net investment income tax. If I die and my wife inherits that, because we're in a community property state, right? So this is community property. She can sell that stock for $1 million and not pay any capital gains tax. I have been talking about this for 30 years. It is amazing how many clients come to my office. They're like, Jim, I've never heard of that. If you're in a community property state, one spouse dies, all community property gets an adjusted cost basis. Certainly if you're single and pass away, all assets that are included in your federal taxable estate, even though you don't pay tax necessarily, get that step up in basis. So that stock you paid $1,000 for that's now worth $1 million, you can go ahead and sell that, or your heirs can sell it free of tax. Very, very big deal. That did not go away. That had been a proposal under prior iterations in our different administration to get rid of that. So it's very, very important. Planning opportunity, harvesting gains and losses strategically before year end. I want you to talk about that, Christina, very briefly. What that is still out there and that we're not precluded from doing that. That didn't change. Maybe briefly discuss what that is.
Yeah, so as far as, if you have, for example, Apple was down significantly in the beginning of this year. And so I think they were down 16+% at one point. And so, and if we take April, for example, when we were having the, Liberation Day pullback in the market and stocks temporarily pulled back double digits, if you sold certain things for a loss of, call it, 10%. So if you had, $1 million, you've got $100,000 of losses. You can bank those and you can use those to offset against gains. So let's just say now maybe you've got some NVIDIA stock and you've got, too much of it in your portfolio and it's up 30% and you want to sell some of that for, sell $100,000 at a gain. You can use that $100,000 of gain to offset that banked loss and use those to offset each other.
But if you don't use it to offset a gain, it just carries forward. You can
Correct.
deduct 3,000 on your income, and you lose that at death. This is a very important one. This loss carry forward, you lose that when you die as a taxpayer. You lose that, so it's very important to pay attention to this if you've sold some stock. But didn't a guy win a Nobel Prize? People don't sell the losers; they sell the winners. I don't know, something about that. Remember that? That was a few years ago. Okay. Real estate investors, 1031 exchanges remain intact. There's also an UPREIT that is a different internal. Is it 731? Is that
721. We'll probably do another webinar on that as well,
Yes.
which creates some liquidity for 1031 exchanges. But 1031 exchanges were kind of being discussed, certainly on the campaign trail, of the Biden administration of eliminating some of those or limiting some of those. So I think that that is a huge win that those remain intact for
Step up repeal
tax deferral.
is the zombie issue that never dies, and you really need to pay attention to this. It really heavily impacts estate planning. Capital gains taxes for most people. Most people don't pay estate tax. Let's face it; it's like 0.01% of estates that pay any estate tax. But the capital gains tax is a much bigger deal. So
sure.
I suppose if the government was really sneaky and crafty, they could just say, all IRAs at death, when you pass away, it's income in respect of a decedent. You have to pay tax right away, and there's no step up in basis, and it's a deemed sale. So if anyone
there's no step up on an IRA. So
well, there's no step up on an IRA. But what I'm saying is I think the government could be way more anyway, sneaky because no one would really understand it.
I think that the 10-year rule really accelerated some taxes for some people, for sure.
But what is it, like 87% of IRAs are liquidated pretty much right at death. And anyway.
Yep.
But a lot of them are small. Okay.
This is that other provision that I was mentioning. So this is new, does not go into effect until next calendar year. So I think we've received a lot of calls on this. Mm-hmm. Those that go, hey, I take advantage of the standard deduction. I give money regularly to these charitable causes. Can we take advantage of that deduction? Not till next year. But $1,000 for individuals, $2,000 for married couples can be given to charity and taken a deduction off of your total income. So again, if you make $100,000 a year and you claim $100,000 a year and you give $2,000 as a married couple to charity, you can reduce your taxable income to $98,000, and then the standard deduction kicks in. So it's an above the line deduction, giving a net effect better return on your charitable gift. Solar, again, the tax credit goes away at the end of this year for residential. So I think that if you haven't already started contracting to get solar done this year, you probably are running out of time for contractors that can get that done this year. But residential goes away. That's getting removed from the tax credit. So I think that this is interesting because I think that those that have had some commenting, is this tax bill favorable to solar? Surprisingly, the residential credit is going away, but the tax bill is actually very favorable to commercial investing and business investments, and still very more favorable, quite frankly, when it comes to commercial investing in solar. This tax bill brought back 100% bonus depreciation. Some states participate in bonus depreciation. Some states allow you to take a deduction if you invest in commercial solar real estate investments. Essentially, rather than investing in real estate, you're investing in solar as a real estate investment. Again, this is not a recommendation, but there are some tax benefits that come from making commercial investments. That's very incentivized in this new tax bill. So I think that there's some misconceptions there as to, does this tax bill favor green energy or solar investments? Solar, it is very favorable, bringing back that 100% bonus depreciation and 40% investment tax credit. So that is actually extended through December 31st of 2027. And I think it went from 85% bonus depreciation to 100.
I guess my take on that is I think it's a bit of a miss because we need more power. We've got this AI thing looming that's going to just suck up tons and tons of power. We need, coal, gas, nuclear, solar, wind, everything.
All of it.
Like all of it, because I don't want to see my power bill go through the roof because I'm using ChatGPT a whole bunch all day. So opportunity zones. What the heck is an opportunity zone? An opportunity zone, if you sell your company and you say, wow, I have this huge capital gain, I got to pay how much in tax? Isn't there something I can do? You can reinvest that gain, for example, into a qualified opportunity zone. And there are funds, and one of them is, I will mention this, one of them is an oil and gas fund that basically any gain, you're not paying capital gains tax on in the future. So then there's a 10-year window on that. We cover that in other webinars, but understand that if you have a significant, and this is a capital gains tax play, the qualified opportunity zone. So if you have a big capital gain, you liquidate a large position of securities. Now, if it's tied to your employment, oftentimes it's basically essentially W-2 comp. So you're kind of screwed, for lack of a better, is that a legal term? Screwed? Yeah.
Yeah, but okay, so this also could apply to like a sale of a stock. So for
Yeah,
example, if you have
that you
Nvidia
own. Yeah.
and you bought Nvidia at, I'm just using round numbers, $100 a share, and now it's worth, $1,000 a share. You got a huge $900 gain per share. That can you could choose to sell, and as long as it's within 180 days, you can put money in from those proceeds into a qualified opportunity zone and defer the gain on the sale of that stock. And you can defer the gain, and then any of the money that is invested, that you'll still have a tax due from the gain on the sale. So you'll whatever the proceeds were, that taxable gain, you've deferred it to a future year, and you will then have that tax bill come due, but maybe that'll be in a year where you don't have as much taxable income. And you can defer it, that tax comes due, but whatever principal you invested in this opportunity zone, however that performs over 10 years, comes out tax free at the end. So if you're investing in something that is highly lucrative, whether it be, oil and gas, whether it be real estate that meets the qualified opportunity zones, these could be potential benefits for some clients, if to the extent that they don't need the principal of those funds
Right.
for 10 years.
Right.
And there will be a lot of new types of qualified opportunity zones coming out late next year. Could you do them still this year? It delays the tax to essentially coming due April 2027. There's just not a lot of juice in that squeeze with what is left in the existing tax code for qualified opportunity zones. Could you do it this year and defer? Sure. Is it going to provide a significant benefit? Probably not. But in late 2026, because again, you can have that 180-day period of time that you can also look back, we're going to see new opportunity zones that are especially going to come out in 2027, because these really start ramping back up in 2027 with new 10-year rolling cycles. And so that will probably be something, if you're looking at selling a business, have huge capital gain. If you can wait till 2027, that will provide some additional tax planning opportunity, because that has been brought into the tax code for continuing QOZs.
I'm going to let you handle 529 expansion because I am major PTSD from putting three kids through varying iterations of private school and college. So I'm going to let you handle that. I'm trying not to remember any of that I went through.
Keep in mind, this is federal guidance, because states do have different guidance. But 529 expansion. So in the K through 12, can you use a 529 plan to cover K through 12 private education? Yes, the expense limit is now increased to $20,000, and it can come out tax-free for primary education, not just college, post-secondary, trade school education. That being said, California does not recognize that and will tax at the state level anything that comes out for primary education. They will only allow it to be tax-free if it is post-secondary, post-primary K through 12 education. So just keep in mind, there are state rules that are different than this new federal guidance. 529 plans post-secondary now can also be used for tuition fees, continuing education. So I know Jim and I, in our careers, we have, not that we're using 529 plans to fund it, but if you have a kid that gets out of college and is a CPA, something that requires ongoing continuing education for their certifications, 529 accounts can be used for their continuing education, exam fees, whether that be, again, medical, legal, CPA, CFP, licensing. You can use these for those types of fees as well.
So, Christina, what about that 2-week tax conference on the Big Island of Hawaii? Would that count?
Probably for the conference, not for your room, board, hotel, all the other things. But for the actual conference, if it satisfies the
Sure.
education, sure. But again,
All
I'm
right.
not a
Trump
tax
accounts.
advisor. Trump accounts, these are new. So this is going to be for any babies. Again, the US is trying to improve its birth rate. So that's really where this came from. We've got too many people drawing on Social Security, not enough people contributing to Social Security. We don't have, our birth rate has been declining. So this is kind of one of those things that got put in the bill, which is interesting. It is for babies born in 2025, 26, 27, and 28. However, we can't create these accounts. So if you had a grandchild or a child born in 2025, we can't open these types of accounts until 2026. So there's just no mechanism. So for example, if I were to go open an account with Schwab or Fidelity or whomever, these types of accounts don't exist yet. So they're coming in 2026, and it will be eligible to be funded much like an IRA, but you don't have to have earned income. So they could be contributed to by, if you're a grandparent and you've got a new grandbaby and they were born in 2025, you could contribute $5,000 contribution, and it will get tax deferred growth, much like an IRA, and it will be able to grow tax deferred. Kind of some other nuances that aren't really on this slide that I wanted to make sure that we spoke to. I don't think we have another slide on this, right, Jim?
No.
Okay. So up to $5,000 in annual contributions can be made. They will be indexed to inflation, just like a traditional IRA or a Roth IRA contribution. Additional contributions are allowed from government, charities, and employers. You have to invest under 18. They have to be invested in an index type of an investment. So it has to be a low cost, like S&P index type of a fund. And so it'll have certain restrictions. We're not, again, these aren't finalized yet, but we're expecting these are the specific types of funds that you can invest in, and that's it. But that will come out starting next year. At age 17, they can be rolled over, and they can be rolled over to an IRA. They can be rolled over to an ABLE account. And so once they are 18, they can then be invested much like an IRA, and there's no restrictions on how they can be invested. So you could have this $5,000 annual contribution. It can sit in there, grow tax deferred. Once you're 18, it can roll over to an IRA, and it will have early withdrawal penalties if withdrawn before age 59 and a half. But you will be able to roll it over to an IRA, have open restrictions, and it's tax deferred. So these are designed to be kind of future retirement accounts and allow for additional contributions for those that are born 25 to 28.
Be a lot of rich people in the 2080s, right? I guess.
Right.
All right. The big picture. I would suggest review your estate plan, review your financial plan, and meet with your tax advisor this year to plan for this year's taxes. The reason estate planning is important is estate planning is really tied, and we didn't really get into it with the different types of trusts. It's inextricably linked with these other planning strategies. And this is very important. If you want to pay less income tax this year, you need to meet with your advisors this year. Do not wait until February, right? Because there's a lot more you can do. There's very little you can do in the following year, but there's a lot you can do this year to reduce your overall taxes. And the reason why it's so important this year is if you get caught between that $500,000 and $600,000 married filing jointly, income bucket, your marginal taxes on that $100,000 slug of income are 45.5%. Your effective rate. So this is just federal only. So it's a big difference. It's $10,000 difference. $10,000 is a lot of money. So I think with the takeaway from the OBBBA is not so much what has changed, because we've gone through a lot, but what should I do now? Well, what should you do? The laws shift, sunsets they're here, they're not. I would say planning early always wins. Your action or inaction in 2025 sets the tone for your taxes in 2026. So what you're going to pay in 2026 largely is determined on what happens in 2025. So very, very important. The best move, see your certified financial planner. Christina is a certified financial planner. This is not amateur hour. Christina has training in very advanced mathematical models to figure out the taxes, because it's not just what you make, it's what you keep. It's not just what you earn on your return on your investment, it's how much the government takes of that slice. And I will tell you, Christina, we have lots of mutual clients. They're W-2 earners, maybe both spouses are working. They're making a lot of money. These people are paying an incredible amount of taxes. And I think if you have a married couple making $1.5 million a year, they're working really hard. That's a big number, but they might be paying $700,000 in tax, which is totally crazy on top of all the other stuff you have to pay. You know, childcare, your mortgage, all this other stuff. It's a big number. So if that's you, there's a lot that you can do this year to reduce your tax bill, but you don't wait till next year is kind of the takeaway. So there's a big change. September 24th, Tasha John, a partner here at Cunningham Legal, and Janice Lee Shen are going to be talking about Medi-Cal changes. Medi-Cal, this is what we're talking about here, is long-term care Medi-Cal. So we're not talking about taxes. We're talking about if somebody can no longer live in the home, if you have a stroke, dementia, Parkinson's, Alzheimer's, and you need to go to a nursing home, that's about $15,000 a month. If people say, I don't have $15,000 a month, the state pays for a big chunk of that. These rules are changing effective January 1. There's a window of time to take action. So if you know somebody or it's you and you're worried about how am I going to pay for my long-term care because my health is declining, definitely you're going to want to check that out. And that, again, is one of our free webinars on the 24th of September. We have office locations in Northern and Southern California. And here is the contact information for Ascent Wealth Management to reach Christina, and they're located, they have offices throughout the state as well. We're going to open it up for questions in just a minute. Now, we have a lot of questions. This is a very popular webinar. If you're watching this on YouTube, go ahead and keep watching because another video is going to pop up. But if you're watching this on YouTube and you go, you know, I'd like to ask questions and have them answered, or I'd like to know what they are, then come to one of our live webinars and you can sign up for one of our live webinars on our website. So I will put this back here. Again, Christina, thank you so much for joining us. We're going to get to our questions right after I stop talking, but thanks for joining us and thank you for watching.